What's going on, everyone? Today, I wanted to talk about the real estate housing market and what I see heading into 2024. So, this is a topic, obviously, that I pay quite a bit of attention to, probably more than most of you listening. It is an obsession of mine, and for good reason, right? It is how I make a living. And so, it's something that constantly we're trying to think of, what's around the corner and where should we be positioning our capital, where are the opportunities, where do they lie. And so it's something that is constantly on my mind. And so really what I think that I've come to a few conclusions. And you won't hear a lot of people that will come out and just give you predictions without all sorts of caveats and conditions. And and usually it's economists that typically don't even invest in the market. And let's just be honest, most of the time they're like the weatherman, right? They're going to be wrong just about at least 50% of the time, or if not more. Probably they're really good if they're wrong 50% of the time. And I feel like you got to be careful when you pay attention to the YouTube people or other people that do not actually have their own money tied up in the market. They don't put their money where their mouth is, I guess, so to speak. And so I try and pay attention to the people. The reason why I like people like Warren Buffett, for example, is because he's someone that is actually every day in the market, lives, breathes, talks about it, but not just talks about it. He actually is actively investing. And so along the way, I love that he's willing to share some of his insight, and he knows that no one's going to repeat what he can do, because really there's only one of one when it comes to Warren Buffett. But the reason why so many people respect and listen to him and hang on every word is because they know that a lot of what he's telling you, I don't think he's doing gamemanship. A lot of times he is very open. He's a very straightforward, vanilla type of investor, but he actually puts his money where his mouth is. And so, similar to him, I guess, in that vein, that's similar to where we're at. I don't try and give anyone advice that I myself am not doing personally. And so, if I am wrong on these predictions, well, guess what? I'll be right alongside anyone else that I guess listens to any of my advice. And I guess I should also preface this by saying that I'm not a financial advisor, that these are the opinions of PJ Million. Take it for what it's worth. And so again, this could be, just take it with a grain of salt. And I'm sure there's going to be things that maybe we agree on, and others that we don't, and that's okay. And everyone's obviously entitled to their opinion. But let's go ahead and dive into it. And I think that I wanted to start the podcast off with asking, I guess, a different question that I have not heard from a lot of people, and that is, what if the home prices that we see today are here to stay? And not just that, they're going to go up. I think I hear so many people talk to me about, when do you think the crash will occur? As if that's a foregone conclusion, as if that's something that will actually happen. Um, and again, I understand why the question exists, because everyone reflects back to the last crisis, which was 2008. I guess if you don't count 2022, which we'll get into later on. But most people that are not savvy investors or whatever in real estate, they think about 2008. That's where everyone's head goes. So I don't really have the time to break down all the reasons why that is a fallacy and will not ever occur again. I think I've done that in prior shows, so I'm not going to get into that. But I am going to ask a different question. And that question is, again, what if the market stays where it's at as far as home prices go? And not just that, it actually becomes even more unaffordable. To me, that is the scariest question of the two, because look, I went through 2008, and I will tell you right now, I loved 2008. As an investor, that was the best time of my life. So this is not coming from someone that is not hoping for another 2008. Um, I know exactly what to do when that situation occurs, to be honest with you. And it's going to be ugly for a minute. But what I noticed was, yeah, it was ugly for 2 to 3 years. The market did its thing. The markets that were open to letting the free market do its thing, it it was painful, but it was quick, and then it turned around, and then eventually demand picked up, inventories slowed down, and then eventually it worked itself out. So I'm okay, honestly, with a crash. What I think we need to be preparing ourselves for, however, is home affordability staying where it's at. And what that means is the first time home buyer might not be able to buy a home, period, for a long time at least, and unless there is some drastic changes, that occurs, maybe with legislation, maybe with affordable housing. But if you ask any contractor, I know that the buzzword that you hear quite often is we need more affordable housing. Guess who builds those affordable houses? Not the government, it's contractors. Guess who's not in the business of losing money? Yeah, you got it too. Contractors. So they're not just out of the goodness of their heart going to start building homes, taking a loss on every single home, just so that a president or Congress can say, "Yep, we got that one figured out. We got affordable housing coming," because the government can't do it, and all they can do is incentivize behavior, right? So even if they did incentivize behavior by changing some of the zoning restrictions and those kind of things, guess what? Inventory doesn't happen overnight. The only time that it did was during a credit crisis. And so the credit crisis, again, if we have to go back to 2008, the reason why that occurred was because a lot of people were in variable loans that were these exotic loans. They should have never been put in, first of all, and they ballooned or they came due within 1 to 3 years. So the issue with that being, okay, this comes to maturity, and I originally locked it in at 5 or 4%, and now it just doubled. I can't afford to pay that. Therefore, I need to let go of the home because the home doesn't have that much equity anyways with everyone else selling. And so I'm better off honestly walking away. Well, turn that around, and that's what you got right now. So 2023, we've got the most qualified buyers in their homes right now, locked in at 3% interest rates. So if you think that someone is going to just willy-nilly let that home go, first of all, it's locked in for 30 years. It's not a variable rate. So they now are locked in at a mortgage rate that they've had now for 3, 4, 5 years, and the cost of living has gone up, but the cost of housing for homeowners has not gone up. So why on earth are they going to sell? Another thing to consider is you have to have two parties, right? You have to have a buyer and a seller, and buyers are sellers and sellers are buyers, right? So you need more people to sell their home in order to then buy a home. And so inventory doesn't come out of thin air. It doesn't come because the government wants it to. It comes because of demand. It comes because contractors see that there's money in it, and so then they then go out and build these properties to then turn a profit. I know that sounds crazy. So again, I think that we need to start thinking, at least if anything, what if the home prices are here to stay where they're at right now, even at 7% interest rate or whatever the case may be. So here's a couple rule of thumbs that I think will help everyone. And this actually is my biggest takeaway for 2024. And I love rule of thumbs because it's very easy to just remember, and you don't have to really listen to the rest of this podcast if you don't want to, because you can pretty much stop right here if you want to know where the market's going to head in 2024. The rule of thumb is this: when interest rates go up, inventory goes down. When interest rates go down, inventory goes up slightly. However, not even close to the amount of demand that picks up which then wipes away any of those gains and home prices increase. So let me just say that back to you again, because I know that that is counterintuitive, because most economists and just about everyone that you listened to last year was saying when interest rates go up to 7 or 8%, and this was the whole premise for the Fed raising the interest rates up to where they are at right now. They actually believed, and for good reason, because historically speaking, this is normally the case. They believe when interest rates go up to a certain level, people would freak out. They would list their homes for sale. They would go homeless because they could not then turn around and buy a home. They just thought people would panic, pandemonium on the street. They would sell their homes, and we would have this glut of inventory, which then would bring down the prices. How'd that work out? I'll wait. So, just again, use your brain here. And I know that this seems incredibly simple, because it should be. And unfortunately, I think the one blind spot for the Fed is in the housing market, which is unfortunate because it makes up, like 30% of the economy. It's not a big deal. But they have a blind spot, and it's very evident and clear in their communication, the way they talk. They talk to stockbrokers. Okay. They talk to Wall Street. They can speak that language. Wall Street would sell off stock and it would be pandemonium. And that's because it's a stock. It's not a home that you live in, right? And so I think it's so important for people to understand the distinction. We all know what happened. When everything went way up on the interest rates and it became super unaffordable to then buy another home, what did everyone do? And this is, by the way, human nature. They paused. They didn't do anything. So that's kind of a problem, because you need inventory to come way up so that it outpaces demand, which then causes prices to then come down because there's competition in the market. That just didn't happen. So what we were left with was historical low inventory levels, even again in 2023. We thought 2022 was the worst, and then it just got 15% worse in 2023. So we are now riding at the absolute bottom of the barrel. When it comes to inventory, there is nothing to choose from. And take that from someone that just moved. And, we had maybe 2 or 3 homes that fit our criteria that we could choose from. And of course, they were priced super high, because why wouldn't they be? There's no one else on the market. So guess what? We ended up having to pay for a property that was not as nice as our home in Arizona. And we paid just under double what we paid in Arizona back in 2012. And so, yeah, like, it stinks. It hurts. It was unfortunate. But honestly, again, where I said at the beginning, I'm putting my money where my mouth is. We just experienced it. I just went out and bought a home at the interest rates where they were at. It was at 6%. And which today is, funny enough, it sounds like that's a bargain all of a sudden. But we did that with a 2-1 buy down, which just means that year one, 2% less for interest rate. So it's in the fours. Year two, it goes up 1%, and then year three goes up another percent. So we were able to make that work because we were banking on the fact that mortgage rates would probably come down from where they were at. Who knows if that's going to happen or not? But at least for a year, we have a lower rate, and then it'll start hurting more and more, I guess. But we had to qualify for it at today's interest rates. So yeah, that's just something to keep in mind when it comes to. So here's the reason why I gave that rule of thumb, and that will answer the question that you might have for what does it look like in 2024 with the real estate market. It's actually pretty quite simple. When you take those rule of thumbs, if you know that when interest rates go down, inventory goes up, but not up enough to satisfy the demand, because demand actually takes off even more. And so it wipes out all of that, new active inventory, and then creates more competition, which then creates, higher prices. I don't think that the home prices have much room to go. That's probably the only silver lining with all of this. I do think that we've hit a level where maybe it'll keep up with inflation, which is where, by the way, it should be. It should be going up about 3 to 5% annually. That's normal, not these 20% increases like what happened with COVID. Um, but again, if you just keep it, and then if you take that rule of thumb and you think about, okay, is the Fed done raising the interest rates? Yes or no? I think that they are, could be wrong. Let's say that they are, for argument's sake. If they are done raising rates, what should happen with the 30-year mortgage rate? Should come down a little bit, possibly stay right around the same where it's at. Um, so, what does that then tell us? If rates stay at or below where they're at today, most likely then home prices will, at a minimum, stay the same, if not increase a little bit. So, that is my prediction for 2024. I actually think that we are going to see some appreciation in certain markets. A lot of markets will probably be, flat. There's only one market right now that's getting hammered still, and that's Austin, Texas. So that is just kind of like a good rule of thumb for everyone to base off of. And again, that is counterintuitive to what normally has happened. And I also wanted to now jump into, okay, how did we get to where we're at right now? All you have to do is remember that we had a decade, roughly a decade, of incredibly historically low interest rates. And so, what is the cause and effect of having low interest rates for that long period of time? Well, if you think about it, many people could buy a home, then they could go buy another home and keep that other home that they had already purchased at 3% interest rate and not have to sell it. So that takes one property off of the market. Maybe they're Airbnb-ing it. Maybe it's a midterm rental. Maybe it's a long-term rental. Maybe it's a vacation home. Either way, they could afford it with their lifestyle because the interest rates were so low. And so if you keep it so low for so long, the issue then is going to be um, you're taking homes off the market. People are now holding them. We did this with our property. This is something that I practice and preach to our investors on a daily basis is hold as much real estate as you possibly can, while obviously being responsible with your cash flow and your responsibilities and all that. But the reason being is real estate historically doesn't really go down, right? It keeps up with inflation, and so it will continue to grow over the years. I mean, just think back. There was one period in time where, yes, obviously there was a crash. Everyone remembers that. But then what happened? Give it 5, 6, 7 years. All of a sudden, it had caught up with itself. Give it another 7 years, and it's gone up 100%. In that short period of time. And so, um, that's how we got here. And so, how do we solve the problem that we're in right now with inventory being so low and demand also being low? Well, it's pretty straightforward. I think that when you have several years of higher interest rates where people are now buying homes and they're having to pay the higher interest rates like we did, well, when they go to buy their next home, they'll probably not be able to afford that next property at interest rates at 6% or higher. So they're going to need to sell that property. And that's a good thing for the market, because what that means is that all of a sudden more properties are being introduced into the market. And then eventually we get to a point where there's equilibrium. And that's really what you want. 2019 was the last healthy market that we had. And so that's what it takes, though, is you want an active marketplace. You want people buying and selling. So that is how we got here. That is how we're going to get out of it. In order to solve that problem, it took a decade to get to record low inventory. So I don't think it's going to take a decade, but it's probably going to take 4 or 5 years, I would imagine, to get back to a normal market. And then during that time, again, when supply is so low, prices are going to probably remain very steady where they're at, if not increase in some areas. So again, that's just something to factor in. Now, here's the risk that I see and that I have seen for a long time. If you are asking the wrong question, in my opinion, of when is the next home crash going to occur, you're going to be sitting on the sidelines. Now, the issue with that is I have so many examples and stories and friends of people that I can tell you about that have sat out since 2018. Okay. They thought that, 2019 was crazy hot. It was going to happen. 2020 occurred. It was for sure going to happen with COVID. Then it obviously heated it up even more when the Fed came in. And then, 2022 finally happened. And I think that's when people were like, okay, now this is it. Every economist just about assumed recession in 2023, home prices coming down in 2023. Neither occurred. Everyone's confused, but they shouldn't be, because no one was paying attention to the actual data, and they weren't really. And this is something that I've been consistent on, for the last couple of years, is that I just don't see this huge crash occurring. And show me the numbers, show me the data, show me something that can show you why, why are you thinking that there's going to be this crash that's going to come around, when there's just no data to support that. So um, the issue being, though, is by sitting on the sideline. Let's say someone's been waiting until the next home crash for the last 5 years. Well, they just lost out on 75% appreciation. That's crazy, right? And so what I always, again, practice what I preach, right? And that's something I'm always constantly reminding myself of, is you have to practice what you preach. So something that we've been doing is, on a consistent basis every year, we try to buy one or two properties to hold for the long term. And whatever we can do, we want to keep that property. So dollar cost averaging is something that, as a financial advisor, I was familiar with and I would preach to everyone, which is essentially just saying, for every month, take out a small chunk of change from your paycheck that you don't really notice is there, and just consistently invest that in the market. That way you don't have to time the market. If it goes up, great. If it goes down, that's okay. If it's in the middle, that's fine too. Over time, though, overwhelmingly, you always come out ahead. So every decade you can look back on and be like, yep, dollar cost averaging works. Same thing with homes. If you just think back over the last 10 years, imagine if you bought one home every year, and you're in 2023, you started buying in 2013. Do you know how you're a multi millionaire at that point, by the way, between your equity and the rental income you've been receiving? I mean, you could retire. So that gives you an idea of, like, if you think it's too late, it's not. Just start today. Start investing and be consistent with it. Let me see if there was anything else that I wanted to go over. I wrote a couple notes down here. Okay. Couple more things. Hopefully, if you guys are, bored, obviously, I'm sure you're just going to turn me off. If you find this interesting, I'm going to give you a couple more nuggets that you can then, reference and think about, and you'll start to pick up on these things as you look at the market. Okay. So another question I get asked quite a bit is, when do you think mortgage rates are going to come down? And it's a great question. It's something that I constantly am looking at every single day. So there's a lot of variables at play here, but one of the big ones is there is a spread. There is a relationship, first of all, between the 10-year treasury and a 30-year mortgage. It has been a slow dance. They call it a slow dance for the last like 50 years, since the 70s, I think. So, right. So, and you can look at graphs that will show this trend, and they just totally follow, right? Up, down. You're going to have them sometimes get really close, sometimes get far apart, but they pretty much go in tandem together. So if you pay attention to the 10-year treasury, that will tell you where mortgage rates are going to be. The variable that you're going to find within that, the distance, the gap, is called the spread. And so right now, the spread is at historical wide gaps, right? This is like if you're going to a dance, you got two awkward teenagers doing their first dance together, and they're just barely touching each other, right? They're just paranoid, scared to death of each other, as opposed to, bumping and grinding or whatever. They're not so close. You got the chauffeurs coming in and breaking it up. So right now, that's where we're at. They are very far apart. And why are they very far apart? It's because uncertainty in the market. Anytime you have uncertainty, and the Fed is treating, I mean, we're basically like a third world country right now, as far as our rates bouncing up and down and everywhere, going up a point, down a point, half a point. That's crazy. That should never happen, by the way. But we're in this situation where we are where we're at because of a lot of stupid decisions by the Fed, in my opinion. And they're always late to the game. But the point of that is the reason why that spread exists is, again, because there's uncertainty. So an investor is not going to agree to lock in a 30-year mortgage rate when they believe that the Fed is only going to turn around and drop interest rates, and their return on that investment is going to be worse, pretty much right away. So their concern is people are going to then refinance out of it, when the rates go down, and that's a problem for them. So they're just not interested. And so to make it interesting for them, they need that spread. They need you to be like, hey, I'm going to offer you incentives essentially to lock this in. And so that's why that spread is so wide. So really, even with the Fed where they're at right now, they could stay put where they're at right now, and if that spread got smaller, the actual mortgage rate would come down. It could come down to like the mid fives, which is crazy. And I don't actually want it to be in the mid fives, because we all know what's going to happen. If it goes down into the mid fives, it will be pandemonium on the street. Everyone is going to start, it'll be 2021 again. And then all of a sudden we're going to have this crazy market. So I actually think it was a good thing the interest rates went up to 8%. It reset expectations. And so, anyways, that's a big reason why the spread exists. And so it's just important to understand that. The only other thing that I wanted to mention is, when it comes to, there's a phrase, or there's a saying and I heard this recently in the Atlanta market and thought it was funny, where they said, drive until you qualify. And so what that's saying is, okay, if you want to qualify for a home, just keep driving. Eventually, you're going to get to some real far outskirt areas that you can then afford. And all of a sudden, housing is affordable, right? You might be in the middle of nowhere and there's no gas station or Walmart or anything, but hey, at least your house is going to be affordable. Um, so I like that saying. And actually, that's a big reason why we ended up uh, out here in Chattanooga, was because we looked at the Atlanta market. I was actually really close to pulling the trigger on the Atlanta market. However, it honestly reminded me of Phoenix. It had already popped like crazy. It's super expensive right now. And so we decided to go drive further to where it was way more affordable. And I feel like that's what's going to happen with our nation is people will start moving from the West Coast, and finding maybe it's the Rust Belt or maybe it's the South or Southeast, and they're going to have to migrate until they find an area where housing is affordable. And so it's a catchy saying, catchy slogan, but it is true. Like, we are realizing that housing affordability is going to be an issue for a while now, and so it might have a massive impact on where migration patterns occur, right? Like where people now might start moving again, just like what we did, where we moved from a very expensive market to a market that is hot. It's definitely hotter than I would like, to be honest with you, in Knoxville, Tennessee, but it's definitely more sustainable. It still has more runway to go. And then Chattanooga has a lot more runway to go, as well as Northern Georgia. So those are the areas that we are actively investing heavily into, because we see this massive opportunity for growth. And that honestly is where I would recommend people look is, and if it's not in those markets, then, maybe look in Alabama, maybe look in some of the sun or the Rust Belt areas, Ohio, and make sure that there's other variables obviously that play into it outside of just the home being affordable and cheap or whatever, and I can get into that another time. But when I looked at all the boxes that I needed to check, that's why I'm here. 100%. I came out here because I believe that this market is one of the healthiest markets that I've seen in the nation and has an incredible potential to grow over the next 5 to 10 years. And so that's why we're located out here. So hopefully all of that helps. I know that ran a little bit longer than I actually anticipated, but I did want to give my 2024 prediction for the real estate market. And hopefully, if you made it all the way through this, you learned a thing or two. But I would love to hear from all of you. If anyone disagrees, would love to hear the logic behind it, because I'm not going to pretend like I know everything by any stretch. But just looking at what I've seen over the last 18 months, I just feel that's where things are heading. I do think that when interest rates go down, it's actually going to have inventory come up just a little bit, which will be great. We're all wanting that desperately to happen, to have more choices to choose from with housing. Unfortunately, I don't think that it's going to last very long, and I think there's a lot of buyers that are going to come and sweep up that have been sitting around for a while, needing a place to move to. And so we'll see, though. Could be wrong, and I'm here for it. I'm excited for next year. I really am. I think we're positioned very well out here in the Chattanooga market. So hope everyone has an incredible Thanksgiving, by the way, and looking forward to Christmas with the family, and excited to go to Dollywood, which I did not know existed, by the way, until I moved out here. And turns out I'm about an hour away from it. And apparently it's like the best place ever for Christmas lights. Very excited for that. If you guys have not been to Dollywood, or if you have actually been to Dollywood, I would love to hear your experience as well. Maybe it's overrated. I'm about to find out. So we're excited to go check that out and experience the holidays here in beautiful Tennessee. All right. Have a great day, everyone.